Millennials, richer in wealth, poorer in milestones. A deep financial analysis. The millennial generation, born between 1981 and 1996, finds itself in a peculiar financial paradox. On one hand, they are the wealthiest generation at their age in history when adjusted for inflation. On the other, many feel stuck, unable to achieve traditional life milestones like homeownership or starting a family at the same pace as their parents or grandparents. This duality of being richer yet poorer is not just a personal sentiment, it's a measurable phenomenon with profound implications for the economy, policy, and investment landscapes. Let's dive into the data, historical context, and broader impacts to unpack why this generational tension exists and what it means for the future. Absolute wealth, relative struggles. When we look at the numbers, millennials stand out as a generation of unprecedented wealth for their age bracket. Federal Reserve data from 1989 to 2022-2023 shows that households aged 26 to 41 in 2022, the millennial cohort, have higher inflation-adjusted net worth across most percentiles compared to similarly aged cohorts in prior decades. Whether we're looking at the median, 50th percentile, the 75th percentile, or even down to the 15th percentile, millennials generally outpace Gen Xers, boomers, and the silent generation at equivalent life stages. This is a testament to broader economic growth, technological advancements, and access to investment opportunities that previous generations didn't have. Yet, absolute wealth doesn't tell the whole story. Below the 15th percentile, millennials are lagging behind their predecessors, burdened by higher debt loads, primarily student loans, and incomes that fail to keep pace with skyrocketing housing costs. Non-home debt, including student loans and credit card balances, has risen consistently over the past 3 decades for this age group, peaking at levels far above what prior generations faced. Even though this debt has slightly declined in recent years, it remains a heavy anchor for many. Additionally, the rent-to-income ratio for millennials hit a record high in 2022, meaning a larger chunk of their earnings is devoured by housing costs compared to past generations. Relative wealth paints an even starker picture. Despite being the largest generational cohort in the U.S., millennials control just 10.7% of total wealth as of Q2 2025, according to the Federal Reserve. Baby boomers, by contrast, hold roughly 5 times that amount. This disparity, driven largely by age and decades of compounded savings and investments, creates a competitive disadvantage for millennials in markets like real estate. The median age of first-time homebuyers has climbed to a record 38, while the median age for all homebuyers is 56. Compare that to historical data from the University of Cambridge. 62% of boomers own homes by age 35, while only 49% of millennials have achieved the same. Lifestyle choices, such as delaying marriage or prioritizing urban renting, play a role, but the financial power imbalance cannot be ignored. Historical context. A generational timing problem. To understand the millennial predicament, we must place it within a historical framework. Millennials came of age during the aftermath of the 2008 financial crisis, a period of economic stagnation that delayed career progression and wealth accumulation for many. Unlike boomers who benefited from post-World War II economic booms, affordable housing, and lower education costs, millennials faced a perfect storm of challenges: soaring tuition, leading to record student debt, wage stagnation relative to inflation, and a housing market inflated by decades of low interest rates and boomer capital. This timing issue extends to wealth transfer dynamics. Boomers, now in their retirement years, still hold vast swaths of wealth, much of which will eventually pass to millennials through inheritance. Some of this transfer is already underway. About 50% of parents are financially supporting their millennial and Z children to the tune of $1,500 per month. However, for the other half not receiving such support, the wait for generational wealth transfer feels like an eternity, especially as immediate needs like housing and debt repayment loom large. Global and sector-specific impacts. The millennial financial paradox isn't just a U.S. phenomenon. It resonates globally. In developed economies like the UK, Canada, and Australia, young adults face similar barriers to home ownership and financial stability due to housing affordability crises and student debt burdens. This generational wealth gap influences consumer behavior, with millennials spending less on discretionary goods and more on essentials like rent, impacting sectors like retail and luxury goods. In the tech sector, millennials have been both beneficiaries and disruptors. Their embrace of digital tools has fueled the rise of tech giants, creating wealth for some through stock ownership or entrepreneurship. Yet the gig economy, often a millennial-driven phenomenon, has also contributed to income instability for many, as traditional benefits like pensions and healthcare are replaced by precarious freelance arrangements. From a stock market perspective, the delayed milestones of millennials could dampen sectors tied to life events such as home building or family-oriented consumer goods in the near term. However, their growing wealth and eventual inheritance suggest a long-term tailwind for investment in real estate, financial services, and technology as they catch up to traditional milestones. Pathways forward: reform, exit, or development. So how can millennials and society at large address this paradox? 3 distinct paths emerge: reform, exit, and development. Reform focuses on systemic change through policy, such as loosening zoning laws to boost housing supply, imposing term or age limits on political leaders to shift power dynamics, or forgiving student debt to alleviate financial burdens. While these ideas are contentious, they reflect a desire to tweak the existing system to better serve younger generations. The exit strategy involves abandoning broken systems altogether. Politically, this manifests as millennial and Gen Z support for ideologies like democratic socialism. Financially, it's seen in the embrace of cryptocurrencies as an alternative to traditional banking. Exit is a radical response to dissatisfaction, but it carries risks of instability and uncertain outcomes. Finally, development prioritizes personal agency over systemic change. This path encourages millennials to focus on what they can control: learning new skills, building relationships, improving health, and managing finances. While less glamorous than reform or exit, development offers the highest likelihood of individual success as it sidesteps the unpredictability of politics or systemic upheaval. Conclusion: investment and policy implications. For investors, the millennial wealth paradox presents both challenges and opportunities. In the near term, sectors like rental housing and student loan servicing may see sustained demand due to millennials' delayed milestones. However, long-term investors should watch for catalysts like generational wealth transfers, which could spur growth in real estate and consumer discretionary sectors as millennials gain financial footing. Near-term catalysts include potential policy shifts on student loan forgiveness or housing reform, which could unlock disposable income for younger generations. From a policy perspective, addressing millennial struggles requires balancing short-term relief with long-term sustainability. Targeted debt relief and housing initiatives could alleviate immediate pressures, but they must be paired with education and labor market reforms to ensure future generations don't face the same hurdles. Ultimately, millennials aren't doomed. They're caught in a timing trap. Their absolute wealth signals potential, but relative disparities and systemic barriers create real frustration. While reform and exit offer collective solutions, individual development remains the most actionable step for millennials to secure their financial future. For investors, policymakers, and millennials themselves, the key is patience. The great wealth transfer is coming, but navigating the interim requires resilience, innovation, and strategic focus.